47%. That's how much the Chicago Mercantile Exchange raised silver margin requirements on January 7th, 2026. Not gradually, not with warning. In one announcement, they increased the performance bond from $22,000 to $32,500 per contract. The official explanation called it a standard response to volatility. The timing told a different story. Because 24 hours earlier, in the city of Rajkot, India, 44 silver trading firms had declared insolvency. $425 million in liabilities. Gone. These weren't retail speculators or amateur traders. These were established trading houses that had been operating for decades, and they all collapsed within hours of each other, caught on the wrong side of what the CME calls risk management. But here's what makes January 7th different from every other margin hike in COMEX history. While those Indian firms were filing bankruptcy papers, while margin requirements were being raised to levels that would force thousands of traders out of the market, JPMorgan Chase was standing for physical delivery on over 8 million ounces of silver. Not closing positions, not rolling contracts forward, taking actual metal out of COMEX warehouses and moving it into their own vaults. The data shows something that's never happened before. According to CME delivery reports, JPMorgan issued 99% of all silver delivery notices on January 7th. They weren't selling silver to meet obligations. They were delivering their own metal while simultaneously taking delivery on the other side. And while the exchange was hiking margins to force traders out, JPMorgan was positioning to take everything that remained. This isn't speculation. The numbers are public. The delivery notices are published daily, and what they show is a bank that spent years holding the largest documented short position in silver history, paying fines for manipulation, settling Department of Justice, spoofing charges, and now holding an estimated 750 million ounces of physical silver, the largest private stockpile ever recorded. Connect these three events: margin hike that bankrupted 44 firms, delivery reports showing JPMorgan taking metal on both sides, and a 70% decline in COMEX registered silver inventory since 2020. The math points to one conclusion. Someone knew the squeeze was coming, and they made sure they'd be on the right side when it hit. To understand what happened on January 7th, you need to understand what COMEX margin requirements actually do. When you buy a silver futures contract, you're not paying the full value of 5,000 ounces of silver. You're posting a performance bond, a deposit that proves you're serious. That deposit was $22,000 on January 6th. Then it jumped to $32,500 on January 7th. A 47% increase overnight. Here's why that matters. If you're holding 10 contracts, you just went from needing $220,000 in your account to needing $325,000. If you don't have that additional $105,000, your broker force liquidates your position. You're out. No choice, no appeal. The CME just changed the rules while you were in the game. The CME will tell you this is normal risk management. They'll point to their rule book. Chapter 7, Rule 802. The board has absolute authority to change margin requirements at any time without notice. When silver hit $83 in December, volatility increased. Higher volatility means higher margin requirements. Standard procedure. But look at the timing. Silver peaked at $83 on December 23rd. Then it started falling. By January 6th, it was trading at $76. Volatility was decreasing, not increasing. The usual pattern is that margin requirements go up during the rally, then come back down after the peak. Instead, the CME waited until silver had already dropped $7, until volatility had cooled, and then they raised margins to the highest level in COMEX silver history. The official explanation doesn't match the data, but it does match something else. On December 2nd, the CFTC's Bank Participation Report showed U.S. banks holding a net short position of 212 million ounces in COMEX silver futures. That's the largest short position on record, and those banks weren't hedging physical inventory. According to the same report, they only held 55 million ounces in long positions. They were net short 157 million ounces with no physical metal to back it. When silver was at $83, those banks were underwater on positions they established when silver was at $30, $40, $50. The higher the price went, the more margin they had to post. At some point, someone's risk department started sending emails, and the CME responded the way it always does when its clearing members are in trouble. It changed the rules. Here's the mechanism. The CME is not a government agency. It's a publicly traded corporation. Ticker symbol CME. Its clearing members, the firms that guarantee all the trades, include JPMorgan Chase, Goldman Sachs, Citigroup, the same banks that show up in the CFTC reports with massive short positions. If one of those clearing members defaults, the CME is on the hook. Their risk management isn't neutral. It's designed to protect the institutions that own seats at the table. So when silver rallied 147% in 2025, when physical premiums started exploding in Shanghai and Tokyo, when registered COMEX inventory fell below 100 million ounces for the first time since the exchange opened, the CME had a choice. Let the market find its natural price, knowing some of their biggest clearing members might face margin calls they couldn't meet, or change the rules to force the other side out first. They chose option 2. And Rajkot, India paid the price. The story in Rajkot doesn't start on January 7th. It starts in October 2025, when India placed an order for 1,000 tons of silver on the London market. The moment that order hit, silver lease rates went from 0.25% to 200%. Every major dealer pulled out. The Swiss refiner Metalor, which operates in 17 countries, announced it wouldn't return to the market until January 2026. India wasn't trying to corner the market. They were trying to meet industrial demand, solar panel production, electronics manufacturing, the same demand that's been running at a deficit for 5 consecutive years. According to the Silver Institute's World Silver Survey, global silver supply in 2025 was 835 million ounces. Industrial demand alone was 720 million ounces. Add investment demand, and you're short by 195 million ounces for the year. That deficit has to come from somewhere. And it came from COMEX warehouses, LBMA vaults, and ETF holdings. The metal that was supposed to be backing paper positions got pulled for physical delivery. By December, the Shanghai Gold Exchange was trading silver at an $8 premium to COMEX spot prices. Tokyo dealers were quoting $130 for physical bars, while COMEX showed $72. The Rajkot firms saw that spread. They saw physical trading at massive premiums. They went long on COMEX futures, expecting the paper price to converge with physical reality. Standard arbitrage. Buy the cheap paper, wait for it to match the expensive physical. Except the CME had a different plan. On January 6th, those firms were holding profitable long positions. Silver had rallied from $28 to over $80. They'd been right about the direction, right about the squeeze, right about the fundamentals. Then January 7th happened. Margin requirements jumped 47%. The additional capital requirement hit at once. Indian trading houses don't have unlimited credit lines with New York clearing firms. When the margin call came, they couldn't meet it. Positions were liquidated. Losses crystallized. $425 million gone. The CME will say these firms were over-leveraged, that they took too much risk, that margin increases are announced publicly and apply to everyone equally. All true, but it doesn't explain why the margin hike came after the volatility peak. It doesn't explain why it happened on the exact day that would cause maximum damage to firms that were correctly positioned for a supply squeeze. And it doesn't explain what JPMorgan was doing while everyone else was getting liquidated. CME delivery reports are published daily. They show who's issuing metal, who's stopping metal, how many ounces changed hands. On January 7th, 1,624 silver contracts were delivered. That's 8.1 million ounces. In COMEX terms, that's a massive delivery for January, which is considered a minor month. Most delivery happens in March, May, July, September, December. January usually sees a few hundred contracts at most, but 1,624 contracts moved. And according to the CME's Issues and Stops report, JPMorgan Chase issued 99% of those delivery notices. They were the ones providing the metal. Simultaneously, JPMorgan was also stopping, taking delivery on the other side. They were playing both sides of the same trade. Here's why that matters. When you issue a delivery notice, you're providing physical silver from your warehouse to someone who's standing for delivery. When you stop a delivery, you're taking physical silver into your warehouse from someone who's delivering. If you're doing both on the same day, in the same size, you're essentially moving metal from one pocket to another while the exchange records it as legitimate delivery volume. This isn't illegal. COMEX rules allow it, but it serves a specific purpose. It maintains the appearance of a functioning delivery market, while the actual available inventory continues to drain. Those 1,600 contracts represent 8 million ounces. COMEX registered inventory. The metal available for delivery currently stands at around 94 million ounces. So this one day's activity represented 8.5% of total registered inventory. But the bigger story is in the pattern. According to data compiled by analysts tracking CME warehouse reports, JPMorgan has been the dominant issuer and stopper since November. They're not just participating in the delivery process, they're controlling it. And while they were doing that, open interest for the January contract was increasing, not decreasing. Normally, open interest drops as expiration approaches. Traders close positions, roll to the next active month, take their profits or losses, and move on. But in January 2026, open interest increased. On January 7th, after those 1,600 contracts delivered, open interest went up by 1,431 contracts. February open interest increased by 1,564 contracts. That means new longs were entering the market and demanding immediate or near immediate delivery. They weren't using COMEX as a hedging tool. They were using it as a physical delivery mechanism, and every contract that stands for delivery drains metal from the registered category. Metal that used to be available to back paper positions. Metal that banks with short exposure were counting on never being claimed. The February contract now has 3,423 contracts of open interest. If even half of those stand for delivery, that's another 8.5 million ounces coming out of COMEX warehouses. At this rate, by March, registered inventory could fall below 80 million ounces. And March is a major delivery month, when the real volume traditionally hits. JPMorgan's position in this is documented through multiple sources. The CFTC doesn't publish individual bank positions, but analysts have reconstructed estimates using bank participation reports, SEC filings for ETFs like SLV, where JPMorgan serves as custodian, and CME warehouse data. The consensus estimate puts JPMorgan's total silver position at approximately 750 million ounces. To put that number in context, annual global mine production is about 835 million ounces. JPMorgan is holding the equivalent of nearly a full year of mining output, and they accumulated it while simultaneously holding the largest short position in COMEX history. They were selling paper and buying physical. Classic manipulation strategy. Suppress the paper price to accumulate physical at lower cost, then flip the position when the squeeze becomes inevitable. This isn't conspiracy theory. JPMorgan paid $920 million in settlements between 2016 and 2020 to resolve charges of spoofing in precious metals markets. 3 of their traders went to federal prison. The Department of Justice called it a racketeering enterprise. The manipulation was proven, prosecuted, and punished. The only question is whether they stopped or just got better at hiding it. The current positioning suggests they saw what was coming and positioned accordingly. Reports from December indicate JPMorgan closed their 200 million ounce short position between June and October 2025. That freed up capital they used to take physical delivery and buy from ETFs. By the time silver hit $83 in late December, they were net long for the first time in 15 years. Then the margin hikes came, and while everyone else was scrambling to meet margin calls or getting liquidated, JPMorgan was standing for delivery, taking metal at $76 that was trading for $130 in Tokyo, 8 million ounces in one day. At a $54 per ounce discount to physical, that's $432 million in immediate arbitrage profit, all enabled by a margin hike that happened to hit at exactly the right time. The timing becomes even more interesting when you look at what happened the week before. On December 29th, banks borrowed $26 billion from the Federal Reserve's standing repo facility. That's the third highest usage since the facility opened in 2021. Year-end liquidity management, according to the official explanation. But year-end was 2 days away. And most year-end borrowing happens on December 31st, not December 29th. Then on December 31st, Reuters reported another spike. Banks were using the facility to manage year-end reporting requirements. Standard practice. But the amounts were unusually large, and the identity of the borrowers is classified for 2 years under Federal Reserve disclosure rules. We won't know which institutions needed emergency funding until January 2028. Connect that to what was happening in silver. Physical premiums exploding. China implementing export restrictions on January 1st that effectively locked up 65% of global refined silver supply. COMEX warehouses draining at the fastest pace on record. Banks sitting on a net short position of 212 million ounces, according to CFTC data from early December. And someone needing emergency funding from the Fed right before the biggest silver delivery month in years. The math suggests a scenario. A bank or multiple banks got caught short physical silver while holding massive paper short positions. As the squeeze intensified, they faced a choice. Default on delivery obligations and admit the paper market is broken, or access emergency funding to buy physical metal at any price and pray the paper price does not rally further. The Fed lending shows up in the data. The identity stays hidden, and the CME solves the problem the only way it can. It raises margins to force the longs out before the shorts have to deliver metal they do not have. The Indian firms were collateral damage. They just happened to be the ones holding profitable positions when the banks needed an exit. This brings us to the index rebalancing. Bloomberg and S&P Global manage commodity indices that track about $120 billion in passive investment. Every January, they rebalance. Assets that outperformed get reduced weight. Assets that underperformed get increased weight. The goal is to maintain diversification. Silver gained 147% in 2025. That performance pushed its weighting in the Bloomberg Commodity Index from 8.19% to a level that required rebalancing. The new weight for 2026 is 3.94%. Goldman Sachs Commodity Index reduced silver from 1.23% to 0.65%. According to analysis from Citigroup, this rebalancing required passive funds to sell approximately $6.8 billion worth of silver futures. Not because they wanted to, not because the fundamentals changed, but because the index methodology demands it. The selling was scheduled to happen over 5 trading sessions starting January 8th. That's $1.36 billion of forced selling per day. Citigroup's commodity strategists, led by Kenny Hu, called this the largest index-related selling flow they'd seen in years. The word they used was unprecedented, and they published that analysis in early January, giving the market advance notice. If you knew this selling was coming, if you knew exactly how many billions would hit the market and exactly when, you'd have a trading edge. You'd know the price was going to drop, regardless of fundamentals. Now at the margin hike, retail longs and smaller institutions get forced out. January 7th. Index rebalancing selling starts January 8th. The price gets hammered, and anyone who positioned short right before the rebalancing or who had access to emergency Fed funding to cover their existing shorts would profit enormously from the forced liquidation. The data shows silver dropped from $80 on January 7th to $73 by January 9th. $7 in 2 days, on over $1 billion of forced index selling. The February contract saw open interest increase even as price fell, suggesting new shorts entered to take advantage of the known selling pressure. And through it all, JPMorgan kept standing for delivery, pulling metal out of COMEX at artificially suppressed prices. This is the mechanism. Use index rebalancing to create predictable selling pressure. Raise margins to force leveraged longs out. Short the market on the way down. Cover at lower prices using physical delivery. And if you run short of actual metal, borrow from the Fed and settle the books before anyone notices. The beauty of the system is that every step is technically legal. The manipulation isn't in any single action. It's in the coordination of multiple legal actions with perfect timing. But there's a problem. The physical market isn't cooperating. While COMEX was showing $73, Tokyo dealers were still quoting $130 for bars. Shanghai premiums stayed at $8 over spot. Dubai and Kuwait markets were showing similar disconnects. The paper price was being driven down by forced selling and margin manipulation. But the physical price kept rising because there's no metal available at lower prices. This is what's called backwardation. Normally, futures prices are higher than spot prices. You pay a premium for delivery in the future because of storage costs and financing. But in January 2026, spot silver was trading above futures. The February contract was at $73, while physical spot was at 80+ in Asian markets. That's backwardation. It means immediate delivery is more valuable than future delivery. It means there's a shortage right now. According to analysis from SchiffGold tracking COMEX data, Silver has been in backwardation since November. The spread has been widening. This is the opposite of what should happen if supply was adequate. If COMEX warehouses had plenty of metal, if the paper market was functioning properly, arbitrage would close that gap. Dealers would buy COMEX futures at 73, stand for delivery, and sell physical at 80. Free money. But that arbitrage isn't happening at scale because there's not enough metal in the warehouses to support it. Registered inventory is at 94 million ounces. Open interest is at 150,000 contracts. That's 750 million ounces of paper, claims on 94 million ounces of physical metal, a ratio of 8-to-1. If even 15% of open interest stands for delivery, COMEX is empty. That's the trap. The paper market needs physical inventory to maintain credibility, but the physical inventory keeps draining because of structural supply deficits and because entities like JPMorgan keep taking delivery. Eventually, you reach a point where the exchange can't deliver. They'll offer cash settlement. They'll claim force majeure. They'll change the rules again. But once that happens, the paper price becomes meaningless. The market will price based on physical availability, and physical is already trading at 130 in Tokyo. The January 7th margin hike wasn't risk management. It was desperation. The CME needed to reduce open interest before the March delivery period. They needed to clear out the longs who might actually stand for metal. And they needed to do it while silver was still falling from the December peak, so they could claim volatility as justification. 44 firms in Rajkot paid the price. $425 million in losses. But those firms were never the target. They were just in the way. The real target was anyone holding a long position who might take delivery. Anyone who might force the COMEX to admit they're running a fractional reserve system with 8 times more paper than metal. JPMorgan figured this out years ago. That's why they flipped from short to long. That's why they're standing for delivery while everyone else is getting liquidated. They know how this ends. When the warehouse runs dry, whoever has physical metal writes the price. And they've positioned to have more physical metal than anyone in history. China's January 1st export restrictions made the squeeze worse. According to reports from Global Times and official Chinese government sources, refined silver exports now require special licensing from 44 approved firms. The licensing process is described as strict, with approval not guaranteed. This effectively gives China control over 65% of global refined silver supply. China is the world's largest silver refiner. They take ore and recycled material from around the world, refine it to 0.999 purity, and ship finished bars to industrial users. That process requires specialized equipment, environmental permits, and massive capital investment. You can't just shift refining capacity to another country. If China restricts exports, there's no alternative source that can replace that volume in the short term. The official explanation is environmental regulation and industrial policy. China wants to prioritize domestic use for solar panels and electronics manufacturing. The unofficial reality is that silver is strategic. It's required for military electronics, missile guidance systems, radar, and advanced communications. Every major power is stockpiling strategic commodities. And China just locked down the world's primary refining capacity 2 weeks before the COMEX March delivery period. This creates a scenario where Western exchanges are showing $73. Western warehouses are at 40-year lows, and the primary source of new refined supply is restricted. Industrial users who need physical metal have 2 options: pay the premium in Shanghai and Dubai, or try to take delivery from COMEX and hope there's metal available. The result is that physical premiums widen, backwardation increases, and the paper market becomes increasingly disconnected from reality. JPMorgan positioned ahead of all of this. They closed shorts when silver was at $35 to $50. They accumulated physical while using the paper market to suppress price. They got access to Fed liquidity if needed, and now they're taking delivery at $76 for metal that is worth $130 in the physical market. That's a $54 per ounce profit on immediate arbitrage. On 8 million ounces taken January 7th alone, that's $432 million. But the bigger play is what happens next. If COMEX inventory drops below 80 million ounces, if March delivery month sees another wave of longs standing for metal, if China maintains export restrictions and physical premiums keep widening, then at some point the exchange faces a binary choice: default on delivery obligations, or admit that the paper price is fiction and let the market trade at physical prices. If that happens, JPMorgan's 750 million ounce position becomes worth whatever the physical market will pay. If physical trades at $150, their position is worth $112 billion. At $200, it's $150 billion. They bought most of it between $25 and $60 per ounce. The profit potential is unprecedented, and all of it funded by manipulation that they've already been fined for, but never stopped doing. The margin hike on January 7th was a signal. It told you who's in control, who's protected, and who's expendable. The Rajkot firms were expendable. They had the right trade, the right analysis, the right position, but they weren't members of the club. When the exchange needed to clear inventory, needed to reduce open interest, needed to help the banks escape their short positions, the retail and mid-size players got liquidated. This has happened before. The Hunt brothers in 1980. They accumulated silver using futures and physical. When the exchange saw the position getting too large, they changed the rules. Margin requirements went up. New position limits were imposed. The Hunts couldn't meet margin calls. They defaulted. The price crashed from $50 to $10. The exchange called it market stability. The reality was that the wrong people were controlling too much of the market. The difference this time is that the manipulation is more sophisticated. It's not one family with a visible position. It's major banks using opaque warehouse accounting, ETF custodial structures, and coordinated margin increases. It's index rebalancing, providing cover for forced selling. It's Fed emergency lending, keeping the system from breaking while the repositioning happens. And it's China providing the ultimate squeeze by locking down supply at exactly the moment. Western exchanges are most vulnerable. The weight of this sits in the data. 70% inventory decline since 2020. 8-to-1 paper-to-physical ratio. Physical trading at 80% premium to paper. Backwardation that's been persistent for 3 months. 5 consecutive years of supply deficits. Industrial demand that can't be reduced because silver has no substitute in most applications. And a bank that's been fined for manipulation, now holding the largest private stockpile in history. Watch the COMEX warehouse reports. They publish daily. Registered inventory is the number that matters. If it drops below 90 million ounces, the pressure increases. Below 80 million, the exchange is in crisis. Below 70 million, force majeure becomes likely. And once force majeure is declared, once the exchange admits it can't deliver physical metal to contract holders, the paper market is finished. Watch the open interest in March contracts. Every contract represents 5,000 ounces. If 10,000 contracts stand for delivery, that's 50 million ounces, half the registered inventory. If 20,000 stand, the warehouse is empty. The question isn't whether this will happen. The structural deficit guarantees it eventually. The question is when and how much warning you'll get before the price discovery moves from paper to physical. Watch JPMorgan's delivery activity. If they keep issuing and stopping in equal amounts, they're controlling the delivery process while actual inventory drains. If they start stopping more than issuing, they're pulling metal out and the end is near. If they stop participating entirely, they've gotten what they need and they're stepping back to watch what happens. This story isn't over. The margin hike was one move. The bankruptcies were one consequence. The position flip was one strategy. But the underlying reality hasn't changed. There's not enough silver being mined to meet industrial demand. China controls most of the refining. COMEX inventory is at multi-decade lows, and someone just demonstrated they'll change the rules, bankrupt the competition, and use emergency Fed funding to maintain control. The 47% margin hike wasn't about volatility. It was about survival. Not your survival, theirs.